Well, it sure sounds like things are getting serious. Bank of Canada Governor Tiff Macklem, he is sounding the alarm, and he's saying that a full-blown trade war with the U.S. could permanently weaken Canada's economy, and there's not much that the central bank can do about it.
The economic consequences of a protracted trade conflict would be severe, but it would be very different, a very different shock than the COVID-19 shock. In the pandemic, we had a steep recession followed by a rapid recovery as the economy reopened. This time, if tariffs are long-lasting and broad-based, there won't be a bounce back. We may eventually regain our current rate of growth, but the level of output will be permanently lower. It's more than a shock. It's a structural change.
I will admit that Macklem isn't the most animated person, even at the best of times, but on this topic, when you look at that video, he looks very, very serious. If you have been sitting around in the background just sort of thinking that this tariff thing will just blow over, I think it's time to sit up and pay attention. So what is happening now? How could it affect you? Let's break it down here. So let's look first at the actual trade war threat and what is at stake. Now, since returning to the White House, obviously President Trump, he's made very aggressive moves, threatening a 25% tariff on Canadian imports. That was delayed, but it's set to come due again very soon. And also steel and aluminum tariffs, also 25%, they're set to take effect on March the 12th. There could be more coming down the pipe. There's cars, lumber, other industries that might be his next targets. Now, for us here in Canada, this isn't just a short-term shock, and this is the crux of the story here. According to Macklem, if these tariffs do stick around, we're not going to see a bounce back like we did after the pandemic. He says instead that our economic output could be permanently lower, a structural change, not just a temporary hit. So what does this mean for Canada's economy? Well, a full-blown trade war would put Canada in a lose-lose situation. First, we have that recession risk. If we see broad tariffs, that could push us into a recession, could shrink exports, would hurt business investment, it would slow consumer spending. None of those are good. Now, we also have to think of inflationary pressures, and at the same time, tariffs would drive up consumer prices, businesses would pass along the higher costs, and the Canadian dollar would weaken. So that ends up leaving the Bank of Canada in a tough spot. I would almost say like a rock and a hard place here. Normally, in a recession, what would the bank do? Well, it would cut interest rates to help boost growth. But if inflation spikes due to the tariffs, then cutting rates could actually make things worse by making prices go even higher. So where are we at? What can they do? Well, Macklem is suggesting a middle ground approach. He's saying providing some support for demand, but not enough to let inflation spiral out of control. Probably easier said than done. The aggressive rate cuts that we saw during COVID-19, that's not going to be an option this time around. So when we look at how bad it can get, the Bank of Canada ran a model to estimate some of the damage that a full-blown trade war scenario would bring, and the results are pretty stark. Exports would be expected to drop by 8.5%. That's huge. Consumer spending would fall by more than 2% by 2027. Business investment would shrink by nearly 12% by early 2026. And overall economic output drops by almost 3% over 2 years. That would wipe out the growth entirely. Now, even in the long run, the economy would not fully recover. And this is where Macklem is estimating that our output would remain about 2.5% lower than if tariffs had never been introduced. Now that takes me to interest rates. Inflation has been cooling down. It came in at 1.9%, the most recent report in January. That is below the central bank's 2% target. And that's why the Bank of Canada has been cutting interest rates. They brought them down to 3% last month after 6 consecutive months of rate cuts. The markets are now pricing in a 40% chance of another rate cut at the next meeting on March the 12th, with 2 more cuts likely before the end of the year. But if tariffs do hit, that would change the calculus, and it would change it right now. Currently, analysts are expecting the Bank of Canada to cut rates 50 to 100 basis points more than planned if Trump's 25% tariffs do in fact become a reality. So what can we do? Well, the Bank of Canada's hands are partially tied right now, and Macklem is calling for more government action. He is suggesting the following: remove interprovincial trade barriers to boost the domestic business. We're going to talk about that more in the next story. Speed up regulatory approvals to make it easier for companies to adapt, and improve east-west transportation links to expand trade beyond the U.S. Now, he also confirmed that Canada's 2% target rate for inflation is here to stay, at least for the time being now. So the Bank of Canada is reviewing its policies, but Macklem doesn't think that it's time right now to reopen that debate. The bottom line here, the U.S.-Canada trade war is not a certainty yet. It looks possible. It looks probable, maybe. The risks are certainly growing of that. So if Trump does follow through with his tariffs, we could feel a major economic slowdown here, higher prices, shrinking exports, long-term damage to growth. So the bank may have to walk a fine line between supporting the economy and keeping inflation in check. What do you think about this? Do you think that Canada should prepare for the worst? Or is this just political posturing? Let me know what you say in the comments. Now, good news. The first episode of the second act, which is my podcast with co-host Adam Bourne, is now live on both Apple Podcasts and on Spotify. So after every YouTube episode in this series, Adam and I will be answering real questions from Canadians just like you to help you build a great retirement plan. Now, episode 2 of Second Act will be out on this channel later this week. For now, you can check out the podcast. And then after we've posted episode 2, send in your questions and we will answer those in the next podcast episode, which is out in mid-March. I'll put a link in the description of this video. Now, I want to move on now to interprovincial trade, and things like cars, homes, groceries, even wine from another province are definitely more expensive than they should be. And one of the biggest reasons for that is the interprovincial trade barriers we've been hearing so much about. It is a mess, a tangle of regulations that makes it harder for businesses to sell across provincial lines. Now, the federal government, they're stepping in and they want to change that. So they're pushing to remove more than half of the exceptions in the Canada Free Trade Agreement. And the goal there is to cut costs and make business easier across the provinces. Two of the biggest sectors that are affected are automobiles and housing. They're already expensive for Canadians in those areas here. Different provinces have different regulations on recycling auto parts, administrative paperwork. This forces the manufacturers to tweak vehicles for every region that they're sold in. And that adds millions in extra costs, which of course get passed on to the buyers. Now, the housing market also faces similar issues. Freight costs for materials like drywall, steel, they're about 8.3% higher because of these trade restrictions. And then on top of that, we have varying business codes across the country. That makes construction more complicated and expensive. We also have to look at licensing restrictions. They limit the contractor's ability to work across the provinces, and that pushes labor costs even higher. Now, food prices, another area that we have to think about when we look at the way that these trade barriers drive up the costs. Dairy, meat, these are especially expensive due to, again, interprovincial restrictions. Now, these restrictions aren't limited to just physical goods. They also create roadblocks for alcohol and financial services. And if we look at an example here, Ontario wineries, they can export to Europe more easily than they can even sell to Quebec. And then you look at craft breweries, they face markups of over 70% when they're selling through the LCBO. The financial industry has very complex provincial regulations that increases compliance costs. Ultimately, where does that go? Well, of course, it gets passed through to you, to us, the consumers. So when we look at the potential changes here, when will they actually happen, or when could they actually happen? Right now, the government's plan could bring lower prices and more business opportunities, but whether the provinces are going to cooperate, of course, that remains uncertain right now. I think that if these changes do move forward, we might see some relief. The challenge, of course, will be making sure that these changes don't get lost in the bureaucracy. That is all for today's program. Don't forget to go and listen to the podcast episode. I will put a link right below here. As always, I say thank you for watching this video. We'll see you again on Wednesday.